Good afternoon, ladies and gentlemen. First of all, I would like to thank the International Securities Services Association for hosting this community session and for inviting me to say a few words about the impact of DLT and tokenization on our industry. And of course, I look very much forward to the latest paper from the ISA Industry Working Group on DLT, which I understand will be published in a few weeks from now. It is clear that technologies such as AI, DLT, API are driving the emergence of a new economy with major implications for the capital markets and the post-trade business. Wide range of traditional and new asset classes are issued and traded increasingly over digital platforms, bringing buyers and sellers closer together. Issuers seek greater access to a wide range of investors globally and look for more transparency and direct communication with their shareholders or beneficial owners. This will require B2B value chains to take into account the values and attributes of peer-to-peer business networks. The value of pure processing of information is decreasing as computational power increases, and further automation and machine learning are taking on more tasks, including decision-making. Participants in the capital markets, inspired by the immediacy and convenience offered by internet-driven business models, are seeking a more real-time, transparent, empowering, and inclusive experience in the capital markets. And finally, the data generated from all the digital interactions has the potential to improve and create new services, but it can also be misused if data falls in the wrong hands. With everything said, one thing stands true. This wave of digitization will bring change. It is unavoidable. New business models will transform the existing value chains with profound consequences and at an unprecedented pace. Over the past years, DLT has emerged as an important piece of technology that promises to deliver this real-time, transparent, empowering, and inclusive experience. Real-time, because it can provide a real-time view of activity and positions across the capital market ecosystem, making it possible to detect, analyze, and react faster to information, threats, and opportunities. Transparent, because it allows participants to share and access one golden source of truth and achieve simultaneous consensus across a data store that is distributed to multiple participants, reducing the risk of information distortion, creating more equal opportunities and better possibilities to set standards. Empowering, because it allows participants to transfer and hold value in a trustless manner without depending on third parties. Needless to say that for assets of material value and services requiring specialized skills, participants still retain the possibility to subscribe to services from specialized and trusted third-party providers. And all should include inclusion by allowing for greater direct participation in the capital markets ecosystem where services can be provided by trusted third parties without mediating information or network, and where same investment opportunities can be offered to a wide range of investors, both big and small, through the benefits of fractional ownership made possible by tokenization. However, similar to other technological changes with transformational potential, DLT will need to overcome certain challenges in our industry in order to cross the chasm from initial proof of concept to mainstream adoption. Real-time does not always mean better. For example, the instantaneous settlement of trades may come with higher liquidity costs or less opportunity for netting. Transparency will have to be balanced with the need for privacy, data protection, and cybersecurity. There will also be a need to establish clear governance and rules of participation, similar to the role played by exchanges, CCPs, and CSDs in today's capital markets. The role for a regulated governor of the network becomes even more important in a decentralized network to ensure legal accountability and adherence to participation rule and compliance. Empowerment will also mean having regulatory clarity and legal certainty supported by neutral and regulated infrastructures as in today's capital markets. And finally, inclusion will only be enhanced by the promotion of standards and the possibility to efficiently interoperate between distributed ledgers as well as traditional systems. Now, it is clear we still have some distance to travel together as an industry. Nevertheless, DLT has already come a long way, and it seems like it's here to stay. So, as I close, I would like to leave you and our panelists with some pertinent questions to reflect on. Should we be trying to fit DLT within our existing processes and paradigms, or should we be reimagining the entire capital markets ecosystem with DLT? More fundamentally, what will be the future business model of post-trade? A model that today is largely based on processing. What will customers pay for in the future? And finally, would DLT, with its full distributed potential combined with unique identity, make customer acquisition irrelevant, giving every service provider, existing ones and new ones, access to a single customer ecosystem? Thank you, and over to the panel.
Joe. Good afternoon, everyone. I'm Jennifer Peavy, Managing Director of Business Innovation at DTCC. I'm really excited to be here today and appreciate ISSA's invitation to moderate today's panel. I'm going to let the panelists do a quick introduction of themselves before we dive in, and hopefully we can address some of the questions that Joe mentioned at the end. Edie?
I'm Astanin. I'm chairman of the executive board of the National Settlement Depository. It's a Russian CSD.
Thank you. Tom?
I'm Tom Zeeb. I head the Securities and Exchanges area at Six Group.
Ryan Cuthbertson. I'm the head of product management for security services at Standard Chartered Bank.
Hi, I'm Vic. I'm the Chief Operating Officer of a company called Nivaura.
Great, thank you very much, guys. So before we get in, I think tokenization is certainly something that I think a lot of folks will probably be interested in today. But I think before we get into that, let's talk about the underpinnings to tokenization. So the distributed ledger platform for a brief moment. I think the industry has been looking at this technology for several years now. There's been a tremendous amount of experimentation. I think we all see the promise and its ability to drive efficiency and reduce cost in the post-trade space. And I'm interested in some of the successes. I think we talk about this a lot, and we hear about POCs, et cetera, but I'm interested in some of the successes that we've had, and especially in terms of how distributed ledger technology can really drive value. And the way that we define value is whether or not it can reduce risk for our customers, costs, provide a better client experience, or deliver on regulatory obligations more easily or efficiently. So Vic, at Nivaura, you guys have been focusing on the issuance side of the business, and your platform has done some interesting things with regards to both traditional and distributed ledger technology. Could you tell us a little bit about the successes you've had on that front?
Sure. So we are a technology company based in the UK, technically still a startup, hopefully not for much longer. From day one, when we started the company, we were focused on automation of the entire process of creating, structuring securities, negotiating them, registering and settling them as well. It was more about providing a solution that could automate all of the fragmented processes pre-settlement, and then automate some event management as well. We always were developing our technology and focused on deploying it for clients, so for investment banks, to integrate with their internal systems. But we always had a view to using a different type of infrastructure in the very long term. At the moment, you have the usual CSD setup, so CSDs, common depositories, etc. Globally, particularly, there's a specific split in Europe where you have the ownership of an instrument that goes into a common depository, and then the beneficial ownership distributed through a CSD, as I'm sure most of the people here are familiar with. While we wanted to deploy technology for customers who could execute traditionally, so register, clear, and settle in a CSD in the traditional system, we also, from almost 4 years ago, were experimenting with clearing and settlement using a decentralized or distributed infrastructure. When we first started, we applied to something called the FCA Sandbox in the UK. They had started something called FCA Sandbox 1, and very luckily we were able to get in. And our proposal to the FCA was automating the issuance of a private placement in the UK, but also tokenizing that on a public decentralized Bitcoin blockchain. Ultimately, we were able to achieve that. We were able to record some of this information of the instrument, tokenize it on a public blockchain, and we then progressed and were able to get into the next sandbox, FCA Sandbox 2. Yep. In FCA Sandbox 2, we were able to issue a fully legally compliant tokenized security, tokenized on the public Ethereum blockchain. We also issued a fully legally compliant cryptocurrency denominated security on the public Ethereum blockchain as well. So that is an Ether denominated financial instrument. That's not us saying that financial markets should move on to a decentralized public infrastructure. It was us using sort of scientific methodology to say, if you were to use this technology, what could be achievable? Yeah. Since then, we've been in every single FCA sandbox, steadily improving or adding on to the executions we've been doing. We're now in the sandbox 5 as well, with a stock exchange and a CSD. And we're looking at registering, clearing, and settling tokenized securities which are compliant under CSDR. Now, the point of all of this backstory is not to pump up Nivaura, is to actually talk about why we've been using a decentralized or a distributed infrastructure. We really believe that there's a lot of opportunity and potential in investment banking to register, clear, and settle instruments on some sort of distributed infrastructure. We're not doing much experimentation with everything pre-registration and pre-settlement. I think it's still out there as to whether a blockchain could be useful there. But definitely in terms of, potentially in Europe at least, uniting legal and beneficial title for an instrument with using an independent third-party infrastructure rather than splitting legal and beneficial title into a CSD and a common depository, that's the potential benefit of using a blockchain. And that would, as you can imagine, remove the need for the traditional setup and potentially also chain of custody. I think the reality in the future will be somewhere in between, where you have a market infrastructure and a market setup that's providing governance over maybe some type of new infrastructure.
Yeah, I think what's interesting about the approach is a lot of times, our clients want value today. And so I think what's interesting is being able to demonstrate a process through existing technology, so improving something today, but also preparing it for future improvements, leveraging these emerging technologies that still potentially need time to mature, right? So I guess let's talk. You mentioned the tokenization side of things, Vic, and so let's dive into that arena. I think, over the course of the last year, there's been a tremendous amount of focus on not only the cryptocurrency side from a custody perspective, but more importantly to our industry, the tokenization of securities, both natively issued on blockchains as well as converting existing securities and storing them, recording them on blockchain. So Tom, I'd like to start with you guys. I think between Ryan, Eddie, and yourself, you all have some experience now in some tokenization platforms. But Tom, if we could start with you around what SDX has been doing and how you envision that platform delivering that value that I spoke about earlier for the industry.
Well, I think there's two sides to it. And, Joe had mentioned in his opening remarks the open question of whether you integrate blockchain technology into existing processes or whether you do something new. We've clearly taken the approach to run SDX in parallel and separate from the value chain, stock exchange, CCP, and CSD, which is all in my area. SDX is being run as a separate unit which collapses all those areas together. Now, what that means, though, over time is you've got these two elements. One is the pieces you talked about, Jennifer, risk reduction, cost reduction, and so on. That is going to take some time to realize. And I think we're getting into a much more mature dialogue now about the benefits of DLT, but also recognizing that you can only realize those real benefits once you start replacing existing infrastructures. And that, in turn, has as a prerequisite that market participants are moving away from their legacy platforms onto digital platforms. That takes time. Mm-hmm. That's not done overnight. And it also requires that the regulators have addressed the various issues around how do you define a token, who's allowed to issue that token, how are you setting standards also around the smart contracts on those tokens to ensure integrity. All those things take time.
Right.
I think the real benefits from a cost reduction point of view will come between 5 and 10 years down the road once that has matured. Where we see short-term benefits, and this was very interesting coming out of the dialogue with our clients, they said, yeah, we see all of that stuff on the back office and tokenizing existing securities, it's great.
Yep.
It's going to take time. Do that, but we'd like to see something that gives us a business case in the next 18 months.
Right.
And that's really about increasing the size of the pie by bringing new native digital issues onto the, in our case, SDX platform, using similar standards that we have for a normal IPO, so the same kind of due diligence and oversight and everything else, and creating liquidity for asset classes that today don't have that liquidity.
Yeah.
And that increases the size of the pie for our stakeholders to offer new products to their customers.
Sure.
So I think in the sort of 2 to 5 year timeline, that's going to be where the benefit is. And longer term, obviously then looking at as soon as we're in a position to start deploying the capabilities to re-tokenize existing securities because the market is ready for it, we'll be doing that.
Sure. And Ryan, can you tell us a little bit about the tokenization platform that you guys have been working on?
Yeah, I can. So firstly, I got to say that Standard Chartered Bank is not a technology company, so I'm a little bit jealous of Vic. So we have the enviable or unenviable task, depending on which way you look at it, of straddling both now and the future. And if you look in particular where Standard Chartered Bank is operating, so predominantly frontier and emerging markets, it's a very different problem that we approach that we needed to solve. So Tom has spoken about releasing trapped liquidity, and particularly in the markets where we are, that is 100% true, and was a focus of the tokenization platform. On the other side, and something that I'm not entirely sure the industry's made a connection to, is when you create an asset, it provides opportunities, particularly in our footprint, to provide that asset to the unbanked. So we were fortunate enough to be able to solve two problems. The first one is for the big end of town, so releasing trapped liquidity through tokenization, and equally as important is for the small end of town and providing access to the underbanked for an asset that historically they've had no access to. So for us, it's a journey. We've managed to do it in a reasonably agile way. So from initial seed to pilot release of the platform has been 12 months, which for Vic, I'm sure is a very long period of time. For a bank like Standard Chartered, I can guarantee you that's a very, very short period of time. And we've managed to do it in under $500,000 of investment. So for a bank that's incredibly fast and in a very low budget, so we've found some unintended consequences along the way, which has been very interesting use cases which we wouldn't have expected to find going in. So you think about tokenization, equities, bonds. But some of the interesting ones we found are term deposits, of course, real estate, private equity as well are some of the obvious ones. So it's been a great experience for us, and something that we're looking forward to working both internally and with external clients to get live and continue to talk about and drive things forward.
Okay, that's interesting. There's some questions I want to get back to you guys on, but first I want to talk to Eddie about the D3 ledger platform. So it's slightly, it's interesting because you guys are not just focused on tokenization of assets, but actually also addressing cryptocurrency as well in this platform. So could you tell us a little bit about that?
Indeed, D3 ledger platform was created by NSD in cooperation with Saramitsu company, Japanese company. And the initial idea to set up this ledger was to give CSD industry a good platform for the development DLT solutions. This idea came to my mind and Monica's mind during our Easter symposium in 2016. And now CSD Group, which we initiated 3 years ago, includes 29 companies. And when we started to discuss with them what is the next step concerning the setting up consortium of CSDs to develop this DLT platform, many of companies said we are not going to put money to this platform. That is why we decided to to make this platform open source platform. Indeed, this platform provides custody services for crypto tokens, securities tokens, and cryptocurrencies. But because cryptocurrencies is not eligible instrument for the CSDs, according to our legislation in Russia in particular, that is why D3 Ledger is open source platform. But it's possible to develop some customized applications of this platform. That is why now we are piloting in Russia new project, tokenization of grain. Russia is one of the biggest exporter of grain, and tokenization of grain, storage grain, or storage vouchers of grain is, it seems us, has quite perspective future. And so another advantage of this platform is that it's being open source platform has some technical possibility to connect to other platforms like Ethereum, Bitcoin, and others. So from this perspective, we believe that such common platform can solve maybe a problem of standardization. And D3 Ledger was successfully tested by in cooperation with KDD, Slovenian Securities Depository, and Liki crypto exchange. That is why this platform went live in May of this year. So it's the next step for the development of our journey in this area.
Yeah, great. Thank you. So just interesting, I wanted to chat about, we've talked about reducing cost for clients as being a key value prop of any solution. With regards to distributed ledger, whether that's a play for just an infrastructure replacement or tokenization, do you think the industry has spent enough time considering that cost-benefit analysis and understanding, the real paradigm of what it means to adopt onto a network like this, and what that means for them from a cost perspective, whether it's storage costs, it's adopting this node and processing costs around it. Have you guys done any work around that space at all with your clients, or has that come up at this point in time? Anyone?
I can start off on that one. I think at an abstract level, yes. Concretely, the efforts we're making are probably still 5 or 6 steps ahead of our stakeholders, largely because they've got a longer life cycle in terms of getting rid of legacy platforms.
Sure.
But certainly in the abstract, our clients understand that the traditional outsourcing models that get tried over and over again with transaction banks and so on, and no one's really cracked that model, in many cases become obsolete because you're mutualizing your processing through the chain. You're eliminating a lot of the reconciliation activity. You can also eliminate, to a large extent, the benefits of a many to omnibus structure and just literally go one-to-one. So it gives a huge amount of flexibility and means that we can, at the operational level, eliminate significant costs in terms of how we process corporate actions, income, tax. All of that can be accommodated through a well-written smart contract. So in the abstract, yes, they get it. In terms of specific use cases, we're still some way off.
Got it. Eddie?
I have a little bit more skeptical point of view concerning this.
I'm with Eddie, also skeptical.
Yeah. We have 4 successful proof of concept concerning implementation DLT in CSD industry: e-voting, OTC report rates and settlement, ICO. But our experience shows that the cost of migration from the traditional system, which well worked in CSDs, to DLT is quite high. That is why we believe that DLT will work well on the markets where infrastructure is not well developed, like on the financial market. That is why we are going to extend our services to commodities market. On these markets, we believe that DLT will bring added value for customers, for CSDs, and for regulators.
Interesting.
I think from the Nivaura perspective, the firms that we're trying to sell to are investment banks, specifically dealers, also custodians, CSD, stock exchanges. We ourselves were from Midland back office before we started Nivaura, so we're very familiar with the likes of Bloomberg, Murex, IPRIO from the technical perspective, from the user perspective. So we naturally have to do a lot of analysis on costs and cost benefit as part of our financial model, and also as part of the engagement with potential clients and current clients, analyzing how new processes or automating existing processes, re-engineering existing processes, and potentially using different types of technology, such as a blockchain, could bring potentially speed to market, cost reductions, etc. For us so far, the main benefit and the biggest cost reduction is really using a blockchain for registration settlement, but also removing potentially the need for splitting legal and beneficial title. That's something that I've mentioned before. Beyond that, I would echo my fellow panelists' comments, and also going back to something Yo mentioned during his presentation. There are pros and cons of implementing a new technology. You have to understand the risks associated with that. It's also opening up the door for information security, which is a big thing at the moment, something which unfortunately parts of my team spend 24 hours a day doing right now. But also compliance, questions about governance, and also questions about re-engineering processes. Just to summarize all of that in short, it's very difficult to understand exactly where the efficiencies are coming from right now. I think you can propose or you can understand them for specific use cases, but once you do those tests, it then opens the door to 10 other things that need to be analyzed. So it's going to be a long process, and I think initiatives like ISA are going to be responsible for bringing all of these thought processes together and all of these results together to understand as an industry where the benefits can and can't come from.
Yeah.
Yeah, I would echo that. For me, it's about finding the right use case for the right application of the right technology. The industry jumps to distributed ledger or blockchain as a solution for everything. It simply is not. But in its right form, for the right use case, for the right client set and the right markets, it absolutely can reduce cost, increase transparency, and create or reduce friction. The important thing, and Vic I think has alluded to it, is that we need to start to be having the conversation around standards. Interoperability between different ledgers is difficult. As part of our platform, we've managed to do it and do atomic swaps. That works in a standard chartered, supported and controlled ecosystem.
Sure.
Letting that go out into the broader ecosystem is still a challenge, and the control around that and the financial crime aspects around that and the cyber aspects around that is increasingly going to be difficult to crack.
Yeah, I think what's interesting is, I mean, APIs seem to be the new buzzword, right? Where DLT was that a couple years ago. And what's interesting is clients are, I think we've heard this already today by the panelists, clients are looking for value now, right? They want to, do they really have the appetite to set this foundation that will really deliver perhaps this value time that you talked about in that 5 to 10 year time frame versus now? What it takes to invest and integrate and test out and deploy some of this technology now, there's a lot of effort, and that takes away from client priorities. So I'm just curious, in terms of your discussions with the ecosystem around demand and their appetite to work through some of this foundational stages before you get to that real value being delivered, how those conversations are going for you guys.
I think from our experience, the clients are clearly not ready to invest in a 10-year vision.
Yeah.
And you can have a lengthy philosophical discussion about that being the malaise of the financial system generally.
Yeah.
But it doesn't change the fact that people are driven by business cases and relatively short-term returns.
Yeah.
I think, and one of the reasons we're setting up SDX and have established it in parallel to the existing structures is because I fundamentally don't believe that there's a business case in replacing old processes with new technology. We've tried it in various places. It does not work, and it comes to your point, Ryan. You know, there are certain places you can implement DLT unless you're looking holistically at the whole thing, which is a much more ambitious activity in terms of creating a new market. You're not going to get a return. It just doesn't make any sense, and no one's going to pay you for it.
Yeah.
So if you're in a situation like our friends at ASX, who had to replace their existing platforms anyway, then it makes sense to go to something new.
Sure.
Because they were going to spend a lot of money on whatever they were going to replace it with in any event. So there it makes sense.
Yeah.
For anyone else who's got a functioning platform, there is, from what we've seen, no business case to do that unless you take that longer term view and you're prepared to hold your breath for a fairly lengthy period of time. And I think maybe that's one of the benefits of being user-owned and user-governed. Our shareholders are our clients, and they have supported the ambition level of looking out into the future and saying, yes, by all means, go for that ambition level. We recognize it's going to be a zigzag path along the way. We'd like to see some new products coming online in the short term that gives us a business case. But longer term, the vision is one that is probably worth pursuing, with all the attendant risks attached to something new.
Yeah, and when it comes to these alternative approaches, right? You know, so it kind of begs the question: if you can have an ecosystem such as the one you just mentioned, Tom, where you have a little bit of patience in terms of building out something new and separate, if you will, there are alternative ways to deliver that value, right? So Vic, you guys have been working, you know, leveraging traditional technology as well as experimenting with some of the emerging technology. When you think about and some of the value in tokenization is about helping to deliver upon those regulatory obligations easier and more effectively using smart contracts on the blockchain. But with your technology, as an example, is there more merit in looking at something short term from a client's perspective around issuance and registration? Perhaps could be one area, but are there other examples where it's more likely that the traditional technologies might win out, do you think?
Very much so. I think the truth is somewhere in the middle. There will be some technologies within the banks used right now that can be replaced by something new, just plug and play. There will be other things that will be replaced through re-engineering of a process or amalgamation of a few different tools into one. But also the reality will be, for example, something like SDX are doing, creating a separate business, putting some of the innovation into there, and then gradually moving bits and pieces of the main business into there. That's partly the innovator's dilemma. That's one of the ways for a large company to be innovative. So really the truth is somewhere in between a few of these areas. We're seeing mixed responses from people like yourselves, from potential customers. We're seeing some who are very willing to innovate from within, replace certain tools they're using at the moment with different versions through us, and then slowly moving more of that business onto a new solution which re-engineers some of those processes as well. We're also seeing other clients and potential clients who are willing to set up slightly different businesses, similar to SDX, creating expert teams from within their organization and then deploying new technology and running a new business line there. So I think these are all in some way successful, and we'll see probably in the medium to long term, probably more adoption amongst some of the shorter term solutions, and then in the longer term, adoption amongst the long term solutions, and probably some convergence as well.
I think it's also worth pointing out, Vic, you'd mentioned this in your first comment, that you're focusing on the post-trade side. And we've kind of taken the same view as regards SDX. The trading is being done on a traditional NASDAQ platform because we didn't see any value in fragmenting a central order book.
Yep.
I mean, if you want to have a liquidity pool, The last thing you want to do is start fragmenting that through a chain. But after the matching, then you start to see some of the benefits coming
Yeah.
through. Now, is that going to be the model for the future? I don't know.
Yeah,
But that's a hypothesis at the moment.
sure.
Trying to get to an ecosystem reimagined, and what would it look like if we were to start from scratch today and draw it on a white piece of paper, and what would be the participant set? Right? Do you need broker-dealer? Do you need sub-custodian? Do you need global custodian?
Where can you reduce the friction?
Yeah, indeed. And then so understanding or having a vision or a crystal ball of and maybe that's where Tom's landing is the right thing to do, understanding how you get there and the incremental steps where you can add value along the way is what we're trying to do as a sub-custodian or custodian in 2019. And selfishly, what does that mean for me if I'm still young enough in 10 years' time? What's my job going to look like? What's the future going to look like? What are the intermediaries that stand in the middle between investor and issuer? And trying to figure that out and stitch it all together is the fun part of today.
Yeah.
Ultimately, I think probably quite closely landing, Thomas, on where you guys are.
Well, and I think there's some realities we just got to deal with, right? I mean, the idea of trading and instant settlement is great. But as Joe mentioned, that does create a liquidity problem, right? And it may be fine in a private banking buy and hold world where you can get the client to pre-fund that. It's clearly not going to be good enough for a prop market of investment banks. So, we're built into our thinking, we have to provide some kind of T plus X model, and probably it will be T plus 2 just because people are familiar with it, and say we're putting a netting engine in the middle. Because you're still going to have prime brokers, you're still going to have short sellers, you're still going to have people doing their core business, and that will develop over time. So somehow, as an infrastructure, you've got to address that.
Yeah.
Because any other solution is not going to be accepted by the market.
Yeah. So I know, Ryan, you mentioned the word standardization earlier, and I guess that's another fun buzzword I hear quite a bit, right? But Eddie, when you think about and you look at all the different types of organizations and providers that are talking about and saying that they want to put forth a standardization, put forth standards around tokenization, DLT, et cetera, how do you really see that shaking out over time, right? Like, is there going to be one organization that ultimately is going to provide some of this guidance? Is it going to be multiples? Is it going to need to be a collaboration of them? How do you see that looking?
I think that tokenization is maybe now it's too early to talk about tokenization in DLT area because we have quite small number of production in this space. That is why maybe in some time it would be quite challenging topic which we face. But now we have some temporary answer to this challenge. I've mentioned that our platform, D3 Ledger, open source platform, which has technical communication with other platforms. So it's means practically communication with different platforms if there is customer demand. So we see that within several years maybe it will be work properly in the answering to standardization question. But if one of the day when customer will ask us about standardization, maybe we will ask Swift to help us because Swift has good experience and resources to develop this tool.
I think it's even more basic than that. So where's the dictionary? So is it a crypto asset? Is it a digital asset? Is it an STO? Is it an ICO?
How do you define a token, all that good stuff?
100%. And just parking for a minute, that different regulators are going to land on different ways to think about it. But and the importance of the work that ISA is doing is to start to have that conversation and bring the community together so that when I talk to the MAS about an STO or a crypto asset, and then I go and talk to the HKMA about it, we're starting from the same basis, right? So that we can have a conversation where we know we're talking about an orange and not an apple or a banana. So it's very, very, very foundational and basic steps that as an industry we need to start getting right.
Yeah, that makes sense. On that the last, I think we got time for one more question. On the regulatory front, right? So I mentioned earlier that a lot of this tokenization, the work around that certainly adds value from a regulatory perspective in terms of being able to bake in the compliance of your instruments. Do you see regulators taking a more proactive approach going forward in terms of driving the use of this type of technology? Is there more of a let's wait and see, or is it just a matter of they need to build confidence in the technology, they're interested, they want to see baby steps? Like, where are you guys, from your different jurisdictional perspectives, where are you kind of seeing the regulators shake out on this?
On the Russian financial market, we have some proactive regulator in this area. We have special national program. It's named Digital Economy, and we have at current time we have draft of law, digital assets. So we expect that within next by the end of this year or maybe 2020 we will get new legislation. It's a good ground for the development DLT activity in different areas, commodities, securities, and etc.
Yeah.
I think from our point of view, we also have a very proactive regulator who has created a separate entity that is dealing with the digital side in a way that is much more progressive than what they've done in the traditional world, where they tend to chase the creativity of the market. I think it's a real opportunity for regulators to start shaping what that market will look like in the future.
Yeah.
And it would certainly be helpful if we could get common ground around definitions,
Sure.
as Ryan had mentioned, so that we know we are talking about the same things.
thing,
And I think it's moving forward. It's not moving forward anywhere near quickly enough. But interestingly, in this space, the regulators are having a constructive dialogue with ourselves and other market participants, rather than just talking to other regulators and politicians who perhaps don't know what they're talking about.
Yeah.
So,
Not perhaps.
in that sense, it's actually good news, even if it's going a little bit slower than I would have hoped. We're fairly comfortable with it.
Yeah.
And across our footprint, it's probably, as you would expect, the major markets have quite progressive conversations. The irony is that when, particularly where tokenization can have its most profound impact, are markets where the regulators are not so open to having those conversations as yet, and it's part of our job to push those conversations along.
Yeah.
4 years ago, if you were to say that there would be legislative and regulatory changes in France and Germany, I would have probably said you're crazy. But it's happened. And regulators are moving. They're moving to understand how new technology could impact financial services. They're understanding how new business models run by existing incumbents or new technology companies could leverage that technology and how that would fit into the overall ecosystem. I can speak for the experience with the FCA and Bank of England in the UK. Within the sandboxes, the FCA simply put more resources into understanding what we wanted to do and into providing governance over any test executions that we actually did. They never flexed the regulation. If things went wrong, we would have been under the full force of the FCA. And that was good because it gave us the opportunity to understand what really keeps them up at night. It gave them the opportunity to understand the business model that we were proposing and the technology we wanted to use. We talked directly to the people who are running and maintaining the handbook. So it was overall a win-win situation. We learned, they learned. We executed something. We published our results. Others have followed suit as well. And you're seeing this being replicated globally. FINMA are doing a fantastic job. MAS as well. BaFin, CNMV are also moving as fast as they can. And these are all positive developments.
Yeah.
I am sympathetic towards regulators. They sit at the center of, they need to understand how the market works. They have to understand what all the market participants are doing, regulation, law, and then they have to provide governance. And if they do one thing wrong, everybody gets on their back. It's a very difficult position to be in. And I think given the developments over the last 4 years with sandboxes and regulatory changes, I think they're doing pretty well. I think we're very lucky at the moment, and that shouldn't be overlooked.
Thank you. So real quick, lightning round. If 5 years from now, tokenization has momentum or not, and recognizing how difficult it is to build liquidity in new assets, yes or no, tokenization 5 years has more momentum?
Definitely yes.
It's a yes for me.
Absolutely. Yes.
Yes.
There you have it, folks. All right, well, thank you very much to their panelists today, and thank you for ISSA for hosting this. So.
Thank you.